Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with the 5 o'clock shadow and with the NMLS number 2028-201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Here we are. It is the Wednesday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Cralle, of course, loan officer, Town Bank Mortgage, right here in Wilmington, North Carolina, where we break down the top stories impacting mortgage rates every single weekday, unless I'm sick, on vacation, or it is the Azalea Festival. And it is neither, so here we are. So, interesting day for me. So, fun day for me. I was on another podcast on Tuesday. And so, and I'll tell you something that's really funny, is I was like nervous. I was like, it was like a different kind of format. I mean, it was still interview show and everything like I do with my Cape Fear Report. But I was, usually I'm the one in control, like controlling things. And it's always kind of weird for me to be answering questions and not asking them. And so I was a little nervous to start, but it was awesome. I will post a link when the podcast goes live. The podcast is called We're Talking Money with OmniStar Financial. Phil Clark heads up that awesome group. And he was the one doing the interviews. And it was really fun. We talked a lot about housing and sort of some of the economics of housing, and it was just fun. It was super fun, and it was great. And I'm looking to try and get Phil on the Cape Fear Report. So super cool, no doubt about that. But we got something to get to today here on the Wednesday edition of Wilmington Mortgage. A plethora of economic data came out on Tuesday, but none of it really moving markets, in my opinion, because there was no real big move. Like all the reports were like slightly better than expected, slightly worse than expected. No major move. So once again, mortgage rates being kind of controlled by what's happening in the Middle East. We saw bond yields fall. 10-year was down about 2 basis points. Slight downward movement, nothing crazy. And then we had Mortgage News Daily was down also by about 2 basis points. The Mortgage News Daily had the 30-year fixed rate index at 6.54%. So like I said, not a huge move, but nothing really happening to cause that move. We got our first look at labor market data for the week. It is jobs week. We got our first report, job openings, and it was pretty underwhelming. It was no real change. And so whenever you see that, it's like markets aren't really going to move. Data from the Bureau of Labor Statistics show openings fell to 6.87 million. That was down from 6.92 million. So really not really a move at all. But it was the third lowest level in the past year. So it is showing some tightening in the labor market with job openings slowing down. Economists were expecting a smaller decline to 6.9 million. So slightly more, but like I said, it's kind of a rounding error at the end of the day. The drop was modest, with job openings falling sharply in professional and businesses services with a 318,000 drop. So kind of a big deal there. 318,000 fewer openings. And then finance and insurance saw a gain of 98,000. So I guess if you were thinking about going to work in professional and business services, which I would think would be finance and insurance, but for some reason it's not, maybe you could go there. There's some job openings that are available there. Total separations, which includes quit, layoffs, discharges, rose to 5.38 million, up from a 5-year low the previous month in February. This is March data. 5.02 million is where it was. It rose to 5.38 million. So a big jump, highest level since June. So not a small move, but important to remember that we were at a 5-year low recently. So not a jump that's really going to cause markets to move. And then quits, the always important part of separations that matter. Quits climbed to 3.17 million. That was the second highest level since June, which suggests that workers are feeling at least somewhat confident. If you're quitting your job, you either have another job lined up or, I don't know, you're independently wealthy. You don't need it anymore. I don't know. But usually it's a sign that workers are feeling somewhat good about the economy in the labor market. So kind of conflicting data with job openings falling, total separations on the rise, but some of that being caused by quits, which is usually a sign of a strong labor market. So kind of a mixed report is what I'm taking away from this. But our first look at labor market data, we're getting ADP later today at 8:15. I think, what is it, 70,000, somewhere around there is what we're looking at. So like I said, kind of a mixed report. No major news that's going to move markets, but the biggest report of the day, no doubt. We did get trade deficit data, which, I mean, unless something crazy happens, does not move markets. But it's always important to know. U.S. trade deficit expanded in March, rising to $60.3 billion. That was up from $57.7 billion in February, and is the second highest level since August. Why? Well, exports and imports increased, but imports rose faster. Exports hit a record $320.9 billion. I think we can round up, $321 billion. Up just over $6 billion from February, while imports climbed by $8.7 billion, so actually a bigger jump. But that number is actually smaller overall. $381 billion. That's the highest level since last March. So we did see a big jump in imports, we saw a big jump in exports, but the jump in imports was bigger. So that's why we saw the trade deficit climb. The widening gap was driven by goods. The goods deficit increased by $4.1 billion to $88.7 billion, while the service surplus grew by $1.6 billion to $28.4 billion. And then, probably not surprising, we are seeing an increase in exports because of oil. Crude oil exports rose $2.8 billion, with gains also seen in other petroleum products and fuel oil. So that makes sense, because some people aren't getting their supply from other places. So, because of something happening in the Strait of Hormuz. And so, therefore, they're like, we'll buy from the U.S. So, a little bit of rise there with oil. But like I said, the trade deficit, I'm one of those who believe the trade deficit is not a horrible thing on its face, as many people believe. Old school economists, people that believe in mercantilism, believe that trade deficits are the worst thing ever. I am not one of them. I solely believe the trade deficit is caused by two things, and two things only. One, we are the global reserve currency, which means foreign countries want our dollar. And one of the only ways to get the dollar is to trade with us. Sell us something that we want, so we give you that dollar. Which, by the way, there's only two ways to get the U.S. dollar if you don't live in the United States. It's to trade with us or a currency conversion. Currency exchange, conversion. And both of those things cause the dollar to rise. Just want to point that out. The cost of the dollar. Because either you do an exchange, which lowers the amount of dollars that are available, or you sell us something, we give you $1, and there's less dollars available. Both results are the same. And then also our budget deficit in the U.S., the $2 trillion a year that we are running, that also causes our deficit, because in order for us to keep borrowing that money without impacting the U.S. economy, it's good for us to get that money from overseas and have people spend the dollars to buy our treasuries. And so, because if we just buy it here, it can crowd out money from the private economy. So I'm one of those people that believes that's what causes the trade deficit. It is, one, we're the global reserve currency, people want dollars, and two, our huge budget deficit in Washington makes it, we want foreign governments to basically be subsidizing our budget deficit. And then we got an ISM report. So we got manufacturing last week. This week we got service sector economy, which was pretty much unchanged. Fell a little bit, but pretty much unchanged. The Institute for Supply Management Services PMI came in at 53.6%, down 0.4 points from March, and is the lowest level since November. Economists were expecting a slightly smaller decline of 53.7. So not a huge difference there. Details were mixed. Business activity rose to 55.9, which shows stronger output, while the employment index did improve to 48%, but it remained in contraction territory for the second straight month. Demand showed signs of softening, with the new orders index dropping sharply to 53.5, a 7-point drop in the lowest level in the last 3 months. And inflation pressures holding steady, with the prices index holding at 70.7, the highest level since October 2022. So that not surprising at all. One of the things they did mention, though, in the report was weakness in housing. Respondents in residential construction said the spring selling season is underway, but higher rates, inflation, and oil-related uncertainty are keeping buyers on the sidelines. Discounts and rate buydowns are still needed to drive sales. And then real estate respondents echoed that concern, noting sales remain well below historical norms and are arguing that if the current pace continues, we could be at the lowest level since 1995 with regards to real estate sales. So some warning signs with regards to services, but for the most part, a uneventful day. A lot of data showing that, we could see some movement here, but these reports did not show anything that's going to cause the market to move. So these movements that we did see, which weren't really that big. I mean, a 2 basis point drop in both the 30-year fixed rate, according to Mortgage News Daily, and then the 10-year down, kind of par for the course. So, we did get new home sales, which I was just looking at the South. Since we're in the South, that's all I really care about. Big jump. It was like 11% jump. And I think it was the highest level since October. So we're still, the South is just driving everything with regards to real estate. Existing home sales, new home sales. The South's like over 50% in a lot of cases. So, yeah, pretty good, I would say. So uneventful day. It is still jobs week. So we got some more reports to come out, and we will keep an eye on the Middle East. But a good day for rates. May not be a great day, but we'll take a good day. All right, you guys enjoy your Wednesday. We'll be back here Thursday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.